A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
I was reading about the latest M&A stats this morning, and it feels like the ghost of 2021 has suddenly decided to haunt Wall Street again. Everyone is talking about this strategic renaissance in investment banking, like there is some kind of gold rush happening right now in March 2026.
It is a massive shift, Corn. I am Herman Poppleberry, by the way, for anyone just joining us. And you are right, the numbers are wild. We are looking at a projected 15% surge in global deal volume this year. It is like the industry spent the last few years in a cold shower, and now they have finally found the water heater.
Well, today's prompt from Daniel is about exactly that. Or rather, the confusion around it. He wants us to break down what investment bankers actually do, and how that differs from the banks where we keep our checking accounts, or where a small business gets a loan. I think most people still have this Wolf of Wall Street image in their heads, but I suspect the reality involves a lot more spreadsheets and a lot less yacht parties.
The gap between the myth and the reality is enormous, especially now. In 2026, the life of a junior analyst is less about throwing parties and more about having their keystrokes monitored by an artificial intelligence while they try to figure out if a $50 billion merger actually makes sense. It is a high-stakes advisory world, and it is fundamentally different from the interest spread model of a retail bank.
Before we dive into the deep end of the pool, let's set the stage with the three silos Daniel mentioned. We've got investment banking, commercial banking, and retail banking. Why do we keep lumping these together? I mean, they all have the word bank in the name, but they seem to be running completely different businesses.
They really are. Think of it as the difference between a high-end consulting firm, a mortgage lender, and a credit card company. Retail banking is what most of us interact with every day. It is your checking account, your savings, your mortgage. They make money on the spread, which is the difference between the interest they pay you on your savings and the interest they charge you on your credit card or home loan. With household debt hitting $18.4 trillion in the second quarter of last year, that is a lot of interest flying around.
And commercial banking is the middle child, right? Serving the small to medium enterprises.
Right, the SMEs. These are the engines of the economy. They need equipment financing, treasury management, and business loans. What is interesting there is the agility gap. Small banks are currently approving about 82% of business loans, while the Big Four are stuck down around 68%. It is a different risk appetite entirely.
But investment banking is the one that gets all the headlines. The Goldman Sachs and Morgan Stanleys of the world. They aren't really interested in my car loan, are they?
Not in the slightest. Their business model is fee-based advisory. They are the matchmakers for the corporate world. When a company wants to buy another company, or when a tech startup wants to go public with an IPO, they hire an investment bank to handle the valuation, the legal hurdles, and the actual sale of shares or bonds. They don't make money on interest spreads. They take a percentage of the total deal value. When you are talking about the mega deals we are seeing in AI and energy infrastructure this month, those fees add up fast.
Speaking of adding up, I saw that Goldman Sachs President John Waldron's pay for 2025 was $45 million. That is more than Jamie Dimon at JP Morgan. If the fees are that high, there must be a lot of pressure to justify them.
There is, and that brings us to the strategic renaissance we are seeing right now. Just last week, on March 19th, we saw a massive regulatory shift. The Federal Reserve, the FDIC, and the OCC finally approved the revisions to what they call the Basel III Endgame.
That sounds like the title of an Avengers movie. What does it actually mean for the banks?
It is basically the set of rules that dictates how much capital a bank has to keep in reserve to prove they won't collapse if things go south. The revisions were actually a bit more lenient than people expected, which is why we are expecting to see about $50 billion in capital released for the large cap banks like Citi and JP Morgan. That is $50 billion that can now be used for dividends, stock buybacks, or fueling more deal making. It is like the regulators just handed the big banks a massive tank of nitrous oxide right as the race is starting.
So the banks are flush with cash, and corporate reserves are high. Does that explain the 15% surge Daniel mentioned? Or is there something else driving these mega deals?
It is a combination of factors. We are seeing a massive need for infrastructure. AI requires an incredible amount of data center capacity and power. Energy infrastructure is being overhauled globally. These aren't small projects, they are multi-billion-dollar transitions. On March 13th, for example, we saw Revolut finally get their full UK banking license. That is a huge signal that the fintech giants are moving from being just apps to being full-scale competitors. Then you have things like MasterCard buying the stablecoin startup BVNK for $1.8 billion on March 20th.
That MasterCard deal is fascinating. It feels like the plumbing of the financial world is being rewired in real time. We talked about the underlying mechanics of these transactions back in episode 1494, the billion-dollar beep. If listeners want to understand the cascade that happens when you swipe a card, that is a good one to revisit. But this BVNK acquisition suggests they are looking at a future where that cascade happens on a blockchain instead of legacy rails.
It is all about payment infrastructure consolidation. If you can own the rails, you own the toll booth. Investment bankers are the ones sitting in the middle of those deals, trying to figure out what a stablecoin startup is actually worth in a world of rising interest rates.
I want to go back to the human element for a second, because this is where it gets a bit dark. You mentioned the junior analysts. Daniel brought up this point about JP Morgan and others using AI to track digital activity, keystrokes, video calls, even how long they are active on their laptops. This is all happening while Jamie Dimon is out there suggesting that AI might eventually lead to a 3.5-day workweek.
The irony is pretty thick, isn't it? On one hand, you have the promise of AI-driven efficiency. On the other, you have a surveillance state for 22-year-olds who are already working 80 to 100 hours a week. The industry is under a lot of scrutiny right now regarding overwork and mental health. The banks are trying to use AI to automate the pitch book creation, which is the grueling manual labor of making those massive presentations for clients. They want to shift the analyst role from being a spreadsheet factory to being a hybrid banker who focuses more on strategy.
But if the AI is doing the work, and the bank is still tracking your keystrokes, it feels like they are just finding new ways to make sure you are never actually off the clock. If an analyst can do 5 hours of work in 1 hour thanks to AI, the bank isn't giving them 4 hours off. They're giving them 4 more hours of work.
That is the fear. It is a transition period. We are seeing the rise of the hybrid banker, but the cultural shift hasn't caught up to the technological one yet. These analysts are being watched more closely than ever, even as their roles become more automated. It is a weird tension. You have these brilliant kids from Ivy League schools who are essentially being treated like high-end data entry clerks with a digital supervisor.
It makes me wonder about the long-term viability of that model. If the job becomes more about managing AI tools than learning the craft of valuation through manual labor, does the next generation of senior bankers actually understand the fundamentals?
That is the big question in the boardrooms right now. If you don't spend your first 3 years building models from scratch, do you have the intuition to spot a bad deal when the AI says it looks good? It is a risk, but the banks feel they have no choice. The volume of data involved in these mega deals is too large for humans to process manually anymore.
Let's shift gears to the commercial side for a moment. You mentioned private credit. These are non-bank lenders who are basically eating the lunch of traditional commercial banks. Why is that happening now?
It is a regulatory arbitrage, mostly. Because commercial banks are so heavily regulated, especially after the March 19th Basel III revisions, they have to be very careful about who they lend to. Private credit firms, like Blackstone or Apollo, don't have those same constraints. They can move faster, offer more flexible terms, and take on more risk. To fight back, the big banks are building what they call capital solutions desks.
Capital solutions desks. That sounds like a fancy way of saying we will find a way to give you money, even if our traditional loan department says no.
That is exactly what it is. They are trying to act more like those private lenders within the framework of a bank. They are blending traditional lending with investment banking techniques. It is a defensive move to keep their mid-market clients from jumping ship. If a medium-sized company needs $300 million to expand, and the bank's loan committee is being too slow, the Capital Solutions Desk can step in and structure a complex debt offering instead.
We saw a version of this with the Augusta Spinco notes offering on March 19th, didn't we? $3.5 billion. That is a massive amount of debt for a subsidiary.
It is a textbook example of debt capital markets in action. Augusta Spinco is a subsidiary of Waters Corporation, and they launched that offering to manage their capital structure during a spin-off. Investment banks like Goldman and Morgan Stanley are the ones who underwrite that debt. They find the buyers, they set the price, and they take their fee. It is a huge part of the ecosystem that most people never see.
It is interesting to see how this all connects. The investment banks are chasing these massive fees, the commercial banks are fighting off private credit, and the retail banks are trying to keep up with fintechs like Revolut, who are now fully licensed. It feels like every silo is under pressure to evolve or disappear.
And then you have the global layer. Look at Tsutomu Yamamoto. He was a big executive at Mizuho, and just this month he took over as the head of the World Bank's MIGA. That is the Multilateral Investment Guarantee Agency. He is trying to scale global guarantees to $20 billion annually.
What does a guarantee like that actually do for a bank?
It reduces the risk of lending in developing markets. If a bank wants to fund a massive energy project in a country with a volatile political climate, MIGA provides the insurance. It is another form of financial plumbing that allows capital to flow into places it would otherwise be too afraid to go. Yamamoto is trying to bring a private sector mindset to a public sector institution. It is all part of this same trend of trying to unlock more capital for these massive global transitions.
While all this money is flowing, David Solomon at Goldman Sachs is sounding the alarm about the $38 trillion U.S. national debt. He is calling it a reckoning. It is a bit of a buzzkill when you are in the middle of a strategic renaissance, isn't it?
It is a sobering thought. You have this boom in M&A, these massive fees, and $50 billion in capital being released by regulators, but it is all happening against a backdrop of record-breaking national debt. Solomon's point is that eventually the cost of servicing that debt is going to crowd out private investment. If the government has to pay more and more interest on its own debt, it drives up interest rates for everyone else.
Which brings us back to that interest spread model we started with. If rates stay high because of government debt, retail banks might make more on their spreads, but consumers are going to get crushed by that $18.4 trillion in household debt. It is a delicate balance.
It really is. And that is why these takeaway points are so important for people trying to make sense of the news. First, you have to understand the Capital Solutions Desk. If you hear a bank talking about that, they are essentially trying to play both sides of the fence, the commercial and the investment banking side, to keep their clients. It is a sign of a bank that is being aggressive.
And the second point is that 3.5-day work week. Don't go quit your job just yet. Even if Jamie Dimon is right about the long term, the short term is characterized by more surveillance, not more free time. The AI is making the work faster, but the banks are just increasing the volume of work to match.
Finally, watch the mega deal pipeline. When you see big moves in AI and energy infrastructure, like the MasterCard BVNK deal or these massive data center mergers, that is the leading indicator for the health of the broader market. These deals take months or years to put together. If the pipeline is full, it means the big players are betting on long-term growth, regardless of what the headlines say about a potential recession.
It is a lot to take in, but it is fascinating to see how the pieces fit together. The banking world isn't just one big monolithic block. It is a collection of very different businesses that are all trying to navigate a world where AI is changing the rules of the game, and regulators are finally letting go of the reins a little bit.
It really is an era of transformation. We are moving away from the old school spreadsheet factory models and into something much more strategic and data-driven. Whether that is a good thing for the people working in those buildings is still up for debate, but for the global economy, it means a lot more liquidity and a lot more activity.
Well, I think we have covered the bases on what these bankers are actually doing in 2026. It is a mix of high-level strategy, intense surveillance, and a lot of matchmaking for the world's biggest corporations.
It is a fascinating world, even if it is a bit exhausting to think about those 100-hour work weeks.
I will stick to being a sloth, thanks. The pace seems a bit more my speed. Thanks as always to our producer Hilbert Flumingtop for keeping the wheels turning behind the scenes.
And a big thanks to Modal for providing the GPU credits that power this show and allow us to dive into these topics every week.
This has been My Weird Prompts. If you are enjoying the show, a quick review on your podcast app really helps us reach new listeners and keeps the conversation going.
You can also find us at myweirdprompts.com for the full archive and all the ways to subscribe.
We will see you next time.
Goodbye.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird